We're going to calculate the stock price for PayPal using prior financial information. And the first step is we need the market cap, which is 179.1 billion. And now the stock price is 152.39. So to figure out the shares outstanding, it's just the market cap divided by the stock price, and they have 1.1 billion shares outstanding. Next, we need the free cash flow. And we can go into Yahoo Finance and the financials and the cash flows. And the best way to calculate the value of a company is to estimate the future free cash flow and discount that back to today's dollars. And that's what we're doing here in today's video. Next, we need net income, which is the profit or loss for a given year. And last, we need revenue. And we're taking 4 years of financial data. And it's good to see the revenue increased every year pretty consistently. So did net income. So it looks like it's on a good trend. Now, we need to look at the capital structure of PayPal and figure out the discount rate we need to apply to the future cash flows. So the interest income is the interest they pay on their debt. And now let's look at the balance sheet to see how much debt they have. And current liabilities, no current debt, but they do have $5 billion of long-term debt. That's debt due after 1 year. So they pay only 2.3% on their debt. But interest payments are tax deductible, so we need to figure out their effective tax rate to deduct the interest. So let's go back to the income statement, and income before tax, and then the income tax. Okay, now the income tax. So they pay 18% taxes in taxes. So when you deduct that from the debt, their cost of debt is only 1.9%. And their capital structure is made up of 3% debt, which is really good. You don't want to see too much debt. Now we need the beta to calculate the cost of equity. And that's also in Yahoo, 1.11, so it's pretty secure stock. And the cost of equity is 10.84%, and we figure that out based off of the capital asset pricing model. As you can see, the cost of equity is a lot higher than the cost of debt because equity sits lower on the capital structure of a company, therefore it's more risky. Because in the event of a default, debt holders are paid before equity holders. And this number, 10.6%, is the price PayPal pays to obtain financing. So PayPal needs to generate at least this in profit a year to add value to its investors. So that's going to be the discount rate we use, the weighted average cost of capital. It's a blend of the debt and equity, 10.6%. So we calculated the future free cash flow based off of their current financials. And we discounted that back to today's dollars. So the value of the company is $115 billion, and we divide that by 1.1 billion shares. We calculate an intrinsic value of $98 a share, even though it's trading at 152. So it was trading closer to intrinsic about a year ago, but it's been bid up a lot. It's at its all-time high, it seems. Stocks can trade higher or lower than intrinsic. The stock price is predicated on supply and demand of the market. The more people that want to buy it, the higher the stock goes. So it doesn't really matter what it's worth, it matters what people are willing to pay. And if you do your research, you'll find some analysts saying, buy PayPal. It's a great buy. Then other analysts will say, sell PayPal. But each analyst uses their own model and their own assumptions. But you never actually see their models. This is my model and my opinion. So hope you liked the video. Thanks for watching.